Hey, what's up, dividend investors? Mike Hiro here for Dividend Stocks Rock. I hope you are doing well. If you have missed it, last week I had a webinar on how to clean your portfolio, and I got so many questions about the number one struggle of all investors: when to sell, right? So today I thought of offering you 3 simple rules of selling stocks. So big red flags telling you there's a problem coming. Maybe you should get rid of it before it's too late. Actually, we're going to start with number 1, which is a little bit too late, and then we're going to work backwards. So the first one is sell on a dividend cut. And that happened to me a few times. Unfortunately and painfully, it happened to me with Algonquin back in 2023. So in 2022, in November, the company reported a very bad quarter. Like, interest rate has gone up like super fast. Most of the balance sheet of Algonquin is actually on variable rate. And well, the problem starts to pile up, the stock dropped, but I don't think it's still a problem at this point. I completely ignored the metrics and I focused on my investment thesis. That was a huge mistake on my part. And then beginning of 2023 happens, conference calls, they cut the dividend. Well, I should have predicted this. That was a failure, but at this point, I just thought, you know what? I'm done. That's my number 1 sell rule. When there's a dividend cut, I sell. I don't even ask myself any questions. And then after that, as you can see on the graph, a few months later, several investors told me, Mike, you should have waited. See, you were wrong. You should have kept the stock. And then it's still on recovery path right now, and you sold at way too low. And I'm like, yeah, you're right. That's fine. But I rather follow simple rules to make my life easier. But here's the thing. Fast forward today, another dividend cut happened in 2024. And yes, while I lost about 50% of my investment when I sold, I would be down by 62% by today. So would I have been better? Definitely not. And you know that between 22 and 25, the market was up quite a bit. Now, you're going to tell me, but Mike, sometimes stocks recover. And here's AT&T, for example. So yes, they had a dividend cut in 22, but after a long walk into the desert, the stock price has well recovered over the past 12 months, and it's now actually getting a lot of momentum. So the dividend is not back there yet, but the stock is still positive, which is great. But here's the thing. If you compare the past 5 years return from the stock market versus AT&T, well, the stock market is up 143%, including the dividend, and AT&T is up 58%, including the dividend. So even though you could have fully recovered before you sell, the opportunity cost here is huge. I mean, the market did almost 3 times the return that AT&T. And this is usually what happens in the best case scenario. You hold on to your losers for like 5 to 10 years. It finally recovers and then you feel good about it. But you completely ignore what you could have done with this money during all that time. So instead, I follow my simple rule. You cut the dividend, you failed me, you're gone. So of course, with this kind of rule, I will be wrong from time to time, and that's okay, because the point is not to be right 100% of the time, because it's impossible, but rather be confident 100% of the time. So by following simple rules, quite easy to achieve. Rule number 2, if there's no dividend growth, the stock must leave. So then again, I had that story, Gentex, amazing business, making auto-dimming mirror, more than 90% of the market shares, absolutely no debt. The company thrived for several years. I had it in my portfolio since 2017, super happy. And then COVID happens. No dividend increase in 2020. No dividend increase in 2021. So I'm like in the wait period because the company still don't have any debts, but that's the problem. Like, I'm a dividend growth investor and I want all my stocks to be fully aligned with my strategy. And after the 3rd year, I finally gave up and I'm like, you know what? I waited 3 years. That was more than enough. And now I'm selling. So I sold at a 50% profit. And since then, well, gonna look back, I kind of made the right choice because the stock price is not going anywhere. The company did not increase its dividend. So I was kind of like having a good profit at a good time. I moved on. However, what I just showed you is usually the best case scenario. When a company doesn't increase its dividend, it's usually a sign that there are more problems, such as what happened with Northwest Healthcare Property REITs, NWH.UN. So this company was rated as a sell in 2022, mostly because they were showing a high payout ratio with no dividend increases, so definitely not doing that well. Well, what happened in mid-23? The company slashed its distribution, the stock price went down, and investors were left with a weak dividend and a big capital loss. So that brings you back to ask you that simple question: why a company stops increasing its dividend? There are actually two reasons for that. The first one, and that's the best one, is, it's capital allocation decision. So the company is thriving, but it decides to use its cash flow to grow the business instead of rewarding shareholders. We have seen that with Constellation Software, or also with WSP Global, and engineering firms that figured out that it was a lot better to use its cash flow to make more acquisitions and get the stock price skyrocketing instead of rewarding shareholders. Even Apple, with a 4% dividend increase rate, is kind of like saying the same thing. They chug so much cash flow, and yet they're just like, hey, you know what? Here's a small dividend increase, but we're going to use most of our cash flow to make the company better moving forward. Unfortunately, those are like exceptions, because the reason number two is a lot more credible. The company's struggling. The company is just not making enough revenue, enough profit to share more wealth with shareholders. And then you have to ask yourself that question: well, do I want the old struggling companies? Because if you look at businesses that are not able to increase their dividend, most of the time the payout ratio is high. Most of the time, the revenue and the earnings not growing. Most of the time, the company is losing steam and is not able to grow and find no growth vectors. So what's going to happen in the future? Well, chances are the dividend cut and a loss of capital is a lot more likely than having a thriving business that suddenly starts to go up. Red flag number 3, sell when you see a weak dividend triangle. So of course, that is the ultimate red flag, is when you have a set of metrics that are not going towards the right direction. So the dividend triangle is quite simple. You look at 3 trends: revenue, earnings per share, and dividend. In an ideal world, they all grow about the same pace, so you know that when the company is making more sales, it also maintains its margin, so it makes about the same level in profit, and then has enough cash flow to reward shareholders and increase its dividend year after year. So not too long ago, I sold my shares of Texas Instrument, mostly based on that reason. The company started to show a declining revenue and declining earnings since 2003. So 23 happens. I waited until the end of 24 actually, and what bugged me the most back then is after 2 complete years of a weakening dividend triangle, the stock price kept on going up, mostly driven by the overall bull market that we had in 24. So towards the end of 24, I just told myself, you know what? The dividend triangle doesn't match the stock price right now at all, so let me sell it, cash a very healthy profit, and run away like a bandit. So typically, I will wait 2 to 3 years before I pull the trigger. This time, I was a little bit faster to pull the trigger after only 2 years, mostly because the stock price was so high compared to where the metrics were going. But again, I'm presenting you the best case scenario, because actually on the other side, that could be a lot worse. Let's take a look at BCE, for example. Right now, you can see that it's been almost 2 years that the revenues are struggling. The earnings per share has been quite struggling for the past 2 years. And then 24 was the time that the company announced it will not increase its dividend right now. So now we're facing a company that stopped its dividend growth, show a high yield, show a high payout ratio, show weak financial metrics. It is becoming urgent that BCE find ways to turn the business around, because at this space, it's not true that it's always going to be fine. It's like saying, well, don't worry, kids, I have like $25,000 on my credit cards, but it's all going to go fine, even though it's for sure that I'm not going to get a pay raise and I have more expenses coming up in the coming months. Well, yeah, that's a real problem, and you want to do a deep dive on this to make sure that this company doesn't end up into the dividend cutters list. All right, so to wrap this up, you can use those 3 red flags as an invitation for investigation. So the first one is dividend cuts. Personally, I just sell, but you might as well do your due diligence. Number 2, weak or no dividend growth. This one is a bit red flag because usually it will be the first sign of a struggling business. And finally, sell on a weak dividend triangle. So a company that is struggling and showing bad financial metrics across the board, well, this is probably the time for you to run. If you're looking for a way to sell the right stocks, but you don't know where to start, I just recorded a webinar on the 5 steps to clean up your portfolio. You can download it at dividendstocksrock.com/webinar. You're going to have the full presentation plus 1 hour of Q&A with it. All right, guys, that's enough for today. Do not forget to give me a thumbs up, like this channel, and of course, until the next video, don't forget to stay invested.